Margaret retired at 62 after more than 3 decades as a school teacher in Ohio. She had a pension that covered most of her bills, a traditional IRA worth about $240,000, and a simple plan that sounded responsible. Leave the IRA alone, let it grow, and touch it only if she ever really needed the money. For years, that sounded smart. Then she turned 73. The IRS rules caught up with her. She was required to start taking distributions, whether she wanted the money or not. That extra taxable income landed on top of her pension and Social Security, pushed more of her income into taxation, and created costs she never expected to face in retirement. What shocked her most was not that taxes existed. It was that nobody had clearly explained that the years before required minimum distributions begin can be one of the most valuable tax planning windows a retiree will ever get, and that a brand new senior deduction created in 2025 only exists through 2028. This content is for educational purposes only and is not tax, legal, or financial advice. Before making any move with your IRA, taxes, Medicare, or retirement income, talk to a qualified tax professional or financial advisor who can evaluate your specific situation. You are watching Us Daily Update, and today I want to walk you through a retirement tax window that many people still do not understand, even though it is sitting right in front of them right now. If you have money in a traditional IRA, a 401k, that will eventually roll into an IRA, or any tax-deferred retirement account that could force future withdrawals into your income, this matters. The reason it matters is simple. Retirement taxes are not only about how much money you have. They are about when the tax bill shows up, how different rules collide in the same year, and whether you choose your tax moments or the IRS chooses them for you. Most retirees have heard the phrase Roth conversion. Far fewer understand why a Roth conversion in 2026 can be very different from a Roth conversion a few years ago, and why the years 2025 through 2028 created an unusually important planning opportunity for people age 65 and older. A Roth conversion is the process of moving money from a traditional IRA into a Roth IRA. When you do that, the amount you convert is generally included in taxable income for that year. That is the part that scares people, and understandably so, because nobody loves volunteering to pay taxes now. But there is another side to the equation that too many retirees never hear explained properly. Once money is inside a Roth IRA, future qualified withdrawals can be tax-free, future growth can be tax-free, and while you are alive, Roth IRAs do not have lifetime required minimum distributions. That means a Roth conversion is not just a tax payment. It is a trade. You are choosing to pay tax on part of the money now in order to reduce or remove future tax pressure later. The opposite happens if you leave all the money in the traditional IRA. It keeps growing tax-deferred, but not tax-free. Every future dollar still belongs partly to you and partly to the IRS. And once you reach the required beginning age, currently 73 for many retirees under existing IRS rules, the government starts forcing withdrawals on its schedule, not yours. That is the part many people miss. A traditional IRA is not a forever shelter. It is a delayed tax bill with a calendar attached. If your account balance is large enough, those required minimum distributions can land right on top of your pension, your Social Security, dividends, interest, capital gains, and any part-time income you still earn, creating a chain reaction of tax consequences that often shows up later than expected and hits harder than expected. Now here is where the current moment becomes so important. In 2025, a new law created an enhanced deduction for seniors. According to the IRS, for tax years 2025 through 2028, individuals age 65 and older may claim an additional $6,000 deduction per eligible person, and for a married couple where both spouses qualify, that can mean $12,000. The deduction is available whether the taxpayer itemizes or takes the standard deduction, and it phases out for taxpayers with modified adjusted gross income over $75,000 for single filers and $150,000 for married couples filing jointly. That one rule alone created a planning opportunity that simply did not exist in the same form before 2025. And at the same time, the current federal tax rate structure did not snap back to the old higher schedule that many planners had long expected. The 2026 IRS inflation adjustments show that the 7 federal tax brackets remain in place with inflation-adjusted thresholds, including a 12% bracket and a 22% bracket that matter enormously in Roth conversion planning for retirees sitting in moderate income ranges. When you combine those two realities, a temporary extra deduction for seniors and a tax rate structure that still allows meaningful room in moderate brackets, you get a narrow period where the cost of converting part of a traditional IRA can be lower than many retirees realize. And because the enhanced senior deduction is temporary, that period does not stay open forever. It exists for 2025, 2026, 2027, and 2028. Then, unless Congress changes the law again, that extra deduction disappears. That is the core of the window. It is not magic, and it is not a loophole. It is a rare period when tax law, age-based deductions, and retirement income timing happen to line up in a way that can favor retirees who act carefully. Let me slow this down, because this is where people either understand the opportunity or completely miss it. Imagine a retiree who is 66, married, no longer working, receiving some Social Security and maybe a small pension, but not yet dealing with required minimum distributions. That retiree may have lower taxable income now than they will have at 73 or 75 once RMDs start. They may also qualify for the enhanced senior deduction. That means there may be a band of traditional IRA dollars they can move into a Roth each year at a lower effective tax cost than they will face later when Social Security is fully underway, Medicare surcharges become relevant, and RMDs stack on top of everything else. In other words, the best time to handle future tax pressure is often before future tax pressure arrives. Consider 3 types of retirees. The first is the person who retires early, maybe at 62 or 63, delays Social Security until 70, and has several years where taxable income is unusually low. That can be one of the best Roth conversion windows in all of retirement, because wages have stopped, Social Security has not started, and RMDs are still years away. The second is the person who has already started Social Security but still has enough room under their tax thresholds to do moderate conversions without triggering unnecessary Medicare pain or moving themselves into a much higher effective tax rate. The third is the retiree who waits too long, lets the IRA keep growing untouched, then reaches 73 and suddenly discovers that the IRS now controls part of their withdrawal schedule. This is why timing matters so much. Retirement tax planning is not only about which account you use, it is about which year you use it in. Now, let us talk about what makes so many retirees freeze when they hear the phrase Roth conversion. They hear, "You have to pay tax now," and the conversation ends. But that reaction is incomplete because it focuses only on the immediate tax bill and ignores the future tax bill you may be avoiding. If you convert $20,000 today and pay tax on it at a reasonable rate, but that same $20,000 would otherwise become part of larger forced distributions later, possibly when your taxable income is already higher, then refusing to pay tax today may not be a savings decision at all. It may simply be a postponement decision. And postponement can become expensive if the account continues to grow. Every year you delay, the future RMD calculation is being built on a potentially larger base. That means retirees who say, "I do not need the money, so I will leave it alone," may be making a perfectly understandable emotional choice, but not always a strong tax choice. The IRS does not care whether you need the withdrawal. Once the rules say the distribution is required, it is required. That is why a retiree with a pension, Social Security, and a sizable traditional IRA can end up with a tax profile in their 70s that is meaningfully worse than their tax profile in their middle 60s. But that does not mean converting as much as possible, as fast as possible. That is where many people get into trouble. In retirement planning, good strategy is rarely about extremes. It is usually about precision. The best Roth conversion is often not the biggest one. It is the right-sized one. That means a conversion amount chosen after looking at taxable income, filing status, the enhanced senior deduction, Social Security taxation, Medicare IRMA thresholds, charitable giving plans, cash flow needs, and the projected size of future required minimum distributions. If you skip that analysis and just convert a random amount because someone on the internet said Roth conversions are always smart, you can create a tax problem almost as easily as you can solve one. So let us talk about the 3 biggest mistakes retirees are making right now with this 2025 through 2028 window. The first mistake is doing nothing because they think later will be better. Later is not automatically better. Later often means less room, fewer deductions, larger required distributions, more taxable Social Security, and more collision with Medicare thresholds. If you are 65 to 72 and sitting on a large traditional IRA, there is a serious chance that your tax picture today is cleaner than your tax picture will be once RMDs begin. That does not mean everyone should convert immediately. It means everyone in that situation should at least run the numbers now instead of assuming the future will somehow be easier. The second mistake is converting without knowing where the phase-outs and cliffs are. The enhanced senior deduction begins to phase out when modified adjusted gross income goes above $75,000 for single filers or $150,000 for married joint filers. That means if you convert too aggressively, you can start shrinking the very deduction that made the conversion attractive in the first place. A retiree may think they are converting dollars in the 12% or 22% bracket, but once the deduction starts fading away, their true effective cost can rise. The third mistake is ignoring Medicare IRMA. Medicare uses prior year income to determine premium surcharges, and in 2026, the first IRMA threshold begins above $109,000 for single filers and above $218,000 for married couples filing jointly. Cross that line, even by a small amount, and your Part B and Part D premiums can jump. Not gradually, but in brackets. That means a Roth conversion can still be worth doing, but the amount matters. The problem is not conversion itself. The problem is conversion without coordination. And there is one more rule that causes real confusion in these decisions: the taxation of Social Security. According to the IRS, provisional income above $25,000 for many single filers or above $32,000 for many married couples can cause part of Social Security benefits to become taxable, and above $34,000 for singles or $44,000 for joint filers, up to 85% of benefits may become taxable. This is sometimes called the Social Security tax torpedo because each additional dollar of income can trigger taxation on benefits you were already receiving. A Roth conversion counts in that system. So if you are already collecting Social Security, the real cost of a conversion may be higher than the tax bracket alone suggests. Again, this does not mean the conversion is wrong. It means the conversion must be sized intentionally. Here is how thoughtful retirees approach this. First, they estimate what their RMDs are likely to look like if they do nothing. Second, they compare that future picture to their current taxable income picture. Third, they identify how much room they have under their preferred tax bracket, under the enhanced senior deduction phase-out, under Social Security taxation thresholds, and under Medicare IRMA lines. Then they decide how much traditional IRA money to move this year, knowing they still have future years in the window to work with. That is the key mindset shift. This is usually not a one-year move. For many households, it is a 3 or 4-year sequence of moderate moves. That is often where the savings come from. Not from one giant conversion, but from a series of carefully controlled annual conversions that reduce the size of the future IRA, reduce future RMDs, and gradually move money into the one retirement account the IRS does not force you to tap during your lifetime. Now imagine two retirees with the exact same $300,000 traditional IRA. One of them does nothing from age 66 through 72. The other uses the current window to convert measured amounts each year while keeping income under key thresholds. By the time they both reach the RMD stage, they are not living in the same tax reality anymore. One may now have a smaller traditional IRA, lower future forced withdrawals, more flexibility, and a growing Roth bucket they can use later without adding taxable income. The other may still have a larger pre-tax account that keeps pushing them into taxable distributions, whether they need the money or not. That is why this matters. Not because Roth conversions are trendy, but because retirement taxes compound through structure. Every good decision gives you more options later. Every ignored decision reduces options later. And retirees need options because retirement is not static. Health changes. Spending changes. Widowhood changes tax filing status. Markets change. Tax law changes. A Roth balance can be a buffer against all of that because it gives you a place to draw from without automatically increasing taxable income. That flexibility can matter just as much as the tax savings themselves. It can help in years with big medical bills, large one-time expenses, capital gains, home sales, or the loss of a spouse. And control matters because one of the cruelest tax surprises in retirement is losing control of timing. That is what required minimum distributions really are, a loss of timing control. The money is still yours, but the schedule is no longer yours alone. That is why retirees with pensions especially need to pay attention. If a pension already fills up part of your lower tax brackets, then future RMDs may begin higher up the ladder than you expect. Add Social Security on top, and the room for painless distributions gets smaller. Add a large IRA balance that has been compounding untouched for a decade, and suddenly the account you thought you were responsibly preserving becomes the account that keeps creating tax friction every year. This is why many planners talk about filling up lower brackets on purpose. Not recklessly, not blindly, but on purpose. A moderate Roth conversion can be a way of using room you already have before the government uses it for you later in a less favorable way. It is strategic tax timing, not tax avoidance fantasy. Now let us make this practical. If you are watching this and wondering whether this applies to you, ask yourself 5 questions. First, do I have money in a traditional IRA or other tax-deferred account that could eventually create RMDs? Second, am I age 65 or older, or will I be during the 2025 through 2028 period, making me potentially eligible for the extra senior deduction? Third, is my income today likely lower than it will be once Social Security, pensions, and future RMDs are all colliding at the same time? Fourth, am I close enough to Medicare and Social Security thresholds that a careless conversion could create collateral damage? Fifth, do I have cash outside the IRA to help pay the taxes on a conversion if I decide one makes sense? That last question is important because paying the tax from outside funds is often far more efficient than withholding part of the conversion itself, especially for people trying to maximize long-term Roth growth. If you convert $20,000 but withhold several thousand from the IRA to cover taxes, then less money actually gets into the Roth to grow tax-free. For many retirees, the cleanest version of the strategy is paying the tax bill from taxable savings and getting the full conversion amount into the Roth. Of course, not everyone has that flexibility, which is why personal advice matters. This is not a one-size-fits-all script. It is a framework. And here is the action checklist retirees should be using right now, before another year disappears. Pull out your most recent tax return and find your adjusted gross income. Know your baseline. Estimate your 2026 income with and without any Roth conversion. Determine whether you qualify for the enhanced senior deduction and how much of it you can preserve before the phase-out starts. Look up the 2026 Medicare IRMA brackets and see how close you are. If you receive Social Security, calculate how a conversion would affect the taxation of your benefits. Estimate your future RMDs if no action is taken. Then compare that future to the tax cost of moderate conversions during 2026, 2027, and 2028. If you already filed a return for 2025 and did not know about the enhanced senior deduction, ask a tax professional whether an amended return may be appropriate in your case. If you are working with a CPA or advisor, ask direct questions. Do not ask, "Do you like Roth conversions?" Ask, "Have you modeled my RMDs at 73 if I do nothing? Have you checked the enhanced senior deduction phase-out? Have you checked the Medicare IRMA thresholds? Have you tested a partial conversion strategy across the next 3 tax years?" If they have not done that work, then they have not really answered the question that matters. Retirement tax planning rewards preparation far more than speed. The goal is not to panic convert before December. In fact, waiting until the last minute is often one of the worst ways to do this because year-end leaves you less room to correct mistakes. The better approach is to start early enough in the year that you can forecast accurately, adjust intelligently, and coordinate across tax return, Medicare impact, and cash flow needs. Margaret's problem was not that she failed to save. She did save. Her problem was that she was told the wrong story about what "leave it alone" really means. Leave it alone until when? Leave it alone under what tax regime? Leave it alone until required distributions start? Leave it alone until more of Social Security becomes taxable? Leave it alone until Medicare surcharges become part of the picture? Leave it alone can be reasonable advice in some situations, but only after the tax consequences of inaction have been tested. Without that step, leave it alone is not a strategy. It is a guess. And retirement is too expensive for guesses. The window is still open right now. The enhanced deduction for seniors is available through 2028, not forever. The current opportunity is real, but it is not permanent. Every year that passes is one fewer year to use the extra senior deduction while it exists, and one fewer year to make these moves on your own terms instead of under pressure. So, if you have been waiting because nobody explained why this moment is different, now you know. The real message is not that every retiree should run out and do a giant Roth conversion tomorrow. The real message is that retirees with traditional IRA money should stop ignoring the years between age 65 and the start of required distributions, because those years may be the most valuable tax planning years of the entire retirement journey. Use them well, and you may lower future taxes, reduce future RMD pain, preserve more flexibility, and create a pool of tax-free money that makes the rest of retirement easier to manage. Waste them, and you may discover too late that the most expensive tax bill in retirement was the one you never planned for while you still had choices.